Everybody thinks they know what a cap rate is. They don't. Most people toss the term around like it's just math. It's not. Cap rate does not equal just math. Stick around. I'll give you the real secret about cap rates most investors miss. And I'll show you how to spot mispriced cap rates again and again. The kind that makes you a pro, the kind that others miss, the kind that gives you a real edge. Buying an 8 cap when it should be a 6 or 7 sounds simple, I know, but that's the game. This is how you make millions in net lease and have investors lining out the door. This video shows you how, step by step, so stick around.
Welcome back to Net Lease University. This is not your dad's version of a cap rate video, and it's definitely not one of those boring explainers you've seen 1,000 times from duplex investors. This is what you really need to know if you care about actual returns. Think of the cap rate as the price tag on income. Get it wrong, and you misprice the entire investment. On paper, cap rate is simple. NOI divided by price. It's the yield you'd earn if you bought the property in cash. At 5% cap rate, a $2 million property produces $100,000 of NOI. At a 6 cap, that same $2 million income stream should only cost $1.67 million. That's a $330,000 swing from just a 1% change. But not all cap rates are equal. A Chick-fil-A at a 5 cap, well, that's not the same risk as a diner at a 7.5 cap. One suggests stability, the other, well, not so much.
Chasing a juicy 8%? Congrats. You may have just bought yourself a tenant who won't finish the lease. And when the rent checks stop, that juicy number suddenly feels very, very dry.
Some people like to quote Warren Buffett. He once said marriages don't last if the kisses stop. Same of cap rates. If the income stops, the number on paper doesn't matter.
Cap rate upon exit is equally important because what you're really doing is buying today's income stream at today's pricing. But your returns are determined by tomorrow's pricing. Buy at a 5 cap today and the market shifts to a 6% tomorrow, well, your valuation just dropped, even if your rent never changed. That shift in exit cap rate can wipe out years of rent growth. Smart investors always ask not just, what's my entry cap, but where is it going?
And don't get too cozy with the forever tenant myth. A 20-year lease doesn't mean a 20-year guarantee. Just ask anyone who thought Blockbuster would be around forever, or Rite Aid, At Home, Zips, Sports Authority. I can go on and on.
Cap rates tell a story, but only if you read between the lines. It's not just about math. It's about tenant strength, rent levels, lease terms, financing, and growth. That's the full picture of risk and return.
Here's the real edge, finding when the market misprices that risk. Say you buy an 8 cap, but every comparable says that tenant, that location, that lease should really trade at a 7 cap. Well, that 1% spread isn't just theoretical. It's built-in upside. It's margin of safety. This is where investors actually make money and not just clip coupons.
If it were easy, everybody would do it. It's not. But there are plenty of opportunities. So what's the secret? How do you spot these? How do you get an edge? How do you find an 8 cap rate that should be 6 or 7 and create that 20% return? It's really 4 ways. Number 1, buy a portfolio and sell one off. You think it's safer to buy a single asset? Nope. Portfolio deals sell at a discount, meaning built-in arbitrage on day number 1.
Number 2, structure a sale-leaseback. A sale-leaseback is when you buy the real estate from another party and then immediately lease it back to them. This is an entire topic in itself and for a later video. Number 3, have great broker relationships. This is critical and will save you time and money. The best deals hardly ever go fully marketed because sellers want to move fast and with confidence. You need to be on this short list and get invited to the party.
And finally, number 4, find distressed sellers. This can take a number of different angles, but it happens all the time. It could be debt is maturing and the seller needs out. Maybe the fund is closing and it needs to sell. Or maybe a death, divorce, etc. that is forcing a sale. It could be a number of things, but the key here is a motivated seller.
And remember, it doesn't take a big shift in cap rates to make a meaningful difference to your returns. Cap rate does not equal just math. They're a story about value, risk, and growth. Learn it now or learn it later, the expensive way.
Want more? We're here. Reach out. Subscribe. This is Nailbox Money, and I'm that lease guy, turning stress into sunsets, one leaf at a time.